What's going on, everyone? Dan again, stocktrades.ca, back at you with another video. With over 100,000 viewers a month over at stocktrades.ca, we get a lot of emails, questions from investors, investment strategies that they email us asking if they're a good way to go about things. And one of the ones we're going to speak on today is called yield on cost. Now, in our opinion, yield on cost, although useful to see how quickly a dividend has been growing, should have absolutely no bearing on the decisions within your investment portfolio. In fact, we think the metric is completely useless, to be honest, and should just be looked at one of those kind of cool to know type things. With that being said, let's dig into what is yield on cost, how investors get tricked by yield on cost, and how it can be costing you a ton of money. So before we get started with the video, we just want to say thank you for the support we've got in the short month and a half we've been running the channel. I mean, we're closing in on 900 subscribers, which is unbelievable in this short amount of time. It allows us to create more videos and really focus on our YouTube platform as well as our website, stocktrades.ca. So if you like the channel, head down below, subscribe to it. If you like this video, smash that like button and hit that notification bell so you don't miss any further alerts from us. So what is yield on cost? Yield on cost is essentially taking your initial purchase price of a stock, keeping that the same, yet comparing the dividends paid as they go up. So a prime example would be a $200 stock that pays a $2 a year dividend. If you purchase that stock today, both your yield on cost and your yield will be around 1%. But let's say a couple years down the road, the dividend has doubled to $4 a share and the stock price has tripled. Your yield on cost is going to be 2%. It's going to be a $4 annual dividend divided by a $200 initial purchase price. But your actual yield is much, much lower than that. You have a $4 dividend divided by a $600 stock price. The value of an investment is not a dollar figure you paid 5, 10, 20 years ago. The value of an investment is what the current market would pay for that investment. So why would we compare a dividend yield back to a stock's past price when we could sell it now for its current market price? Currently, we have $600 in capital tied up to earn a $4 dividend. Whereas if we were to sell those shares and buy 6 shares of a $100 stock yielding 3%, we would be yielding $18 a year from those 6 stocks. That is more than a 400% increase in terms of income. When you're using yield on cost, it's easy to get the illusion that there's simply no other stocks on the market that are going to match what you're getting now. A prime example would be Go Easy Limited. If you were to have purchased the stock in 2004 when it started issuing a dividend at around $10.50, your yield on cost right now would be over 16% because the company currently yields about $1.80 a share per year. You're not going to find any common shares that yield that amount here in Canada, and if they do, we can almost guarantee you that the dividend is not safe. And as a result, a lot of investors who rely too much on yield on cost to judge the efficiency of their dividend portfolio might think, well, I can't sell this stock, it's yielding me over 16%, when in reality the yield is just over 2 at Go Easy's current price. Now, you won't unnecessarily be unhappy with Go Easy since 2004. I mean, the stock has gone from $10.80 to nearly $80 today. But the fact is, if you're looking to generate more income in retirement and not touch the principal, you need stocks that are paying you lucrative dividends. And Go Easy, currently paying $1.80 a year per share, is yielding around 2.2%, not the over 16 that someone focusing on yield on cost would think they're getting. Instead, what you should be doing is building a strong portfolio of companies with high yields. If a stock's price has run up a lot and their yield is dropping, if you're investing solely for the income, you might want to think of moving on from that stock and investing it in a stock that's cheaper yet yields more. Overall, if you're building a portfolio for income, yield on cost should have absolutely no bearing on the holdings within that portfolio. The only thing focusing on yield on cost in terms of the holdings within your portfolio is going to do is lead you to make mistakes that ultimately cost you money. So that's it from me in this video. Pretty short video, pretty direct video. But the number one thing to take away from this is if you are using yield on cost to value the current holdings of your portfolio, stop. If you're using yield on cost to judge how quickly one of your stock's dividends is increasing, that's okay. It just shouldn't have any bearing on the stocks you hold within the portfolio. As always, subscribe to the channel, like the video, hit that bell at the bottom to get notifications on our next video, and we'll see you next time.